So good afternoon, everyone, and thank you very much for joining our webinar this afternoon. I'm Peter Burrell. I'm a partner in Willkie, Farr and Gallagher's London office, and I lead our litigation enforcement and compliance function here in London. And over the last 30 years, I've spent a lot of time either helping companies and directors in dealing with financial statements issues and dealing with investigators, whether that's from the various regulatory bodies in the UK, and also defending individuals who've been caught up in allegations around financial misstatements. This afternoon, we've got an excellent panel that we've assembled. This is our first combined Willkie, Farr and FRA panel webinar, and I'm looking forward to a very interesting discussion this afternoon as we bring our different skills to bear. I'll hand over in a moment to Willkie, who will do the introductions, but before I do so, just one very important housekeeping matter. For all of those of you who are seeking CLE credit, then please would you click on the attendance sheet link that will be sent to you by my colleague Rebecca Sears. Please make sure that you enter the code that will be given during the course of this presentation. I'll do that about a third of the way through. And then please also enter the time of arrival and time of departure for the seminar, and then you can claim the credits for attending the webinar this afternoon. So that's all from me for now. Thank you very much for attending, and over to Willkie for the introductions. Thank you.
Thank you, Peter. So my name is Willkie. I'm one of the directors at Forensic Risk Alliance, and I'll be the facilitator for today's webinar. So the topic we have today doesn't require further introduction. Hardly a day goes by without us seeing something hitting the news about accounting scandals and auditing concerns, both in the US and here in the UK, particularly Valerie, Caribbean, Freddie Mac, Fiat Chrysler, PPG Industries, Wirecard, just to name a few. We have also seen a lot in the press calling for professional services firms to actually split their audit and consulting practices. Some of us probably will remember some of the historical occurrence that we've seen on the demise of Enron in 2002, which sparked the breakup of Arthur Andersen. Just last week, the FRC, from the Financial Reporting Council, announced sanctions against Grant Thornton and two of its senior members of the engagement team in relation to the audit of the financial statements of Conviviality Retail PLC. Now, the FD also reported that Deloitte is facing a record £15 million fine for serious and serial failures in its audit of Autonomy. And they commented that this was a continuing series of misconduct involving a lack of care and competence by the whole audit team. The FRC also issued an edict and a 22-point plan for the operational separation of UK's Big Four accounting firms by 2024. And the Big Four are required to outline how they will achieve this by the end of October this year. Now, suffice to say, there are lots of focus and pressure on financial reporting at the moment on companies, in particular for the board of directors and the audit committees, in discharging their responsibilities, auditors, regulators, and enforcement agencies. We're joined by four very distinguished members of the panel today. Cara DeGarry is a partner here at FRA, and she has 35 years of professional experience as a certified public accountant with expertise in forensic investigations, auditing, accounts, and accounting. Her prior experience includes 8 years spent at the Public Accounting Oversight Board, PCAOB for some of us, and 3 years at the US Securities and Exchange Commission, SEC, where she conducted investigations of public companies and their officers and directors, as well as investigations of external audits of public companies. Matthew Ruiz is a director at FRA and an experienced forensic accountant, internal and external auditor. And he has investigated many cases of accounting fraud and designed and implemented audit programs to identify and address fraud risks. In addition to Peter, who you heard from earlier on, we're also joined by Simon Osman-King, partner at Willkie's Litigation and Compliance Investigations and Enforcement Practices in London. You will see from the bios, Peter and Simon's experience covers across a broad range of domestic and cross-border investigations, compliance, and litigation, and they have acted on some of the most important matters in the London market. So on the agenda today, we will cover considerations for audit committee members, legal risks faced by audit committees, audit quality, and auditing in the pandemic. Throughout the webinar, please feel free to use the Q&A function to submit questions that you would like to address, to be addressed by our excellent panel. We would love to hear from you on the subject. Now, without further ado, I would like to invite Carol to kick off today's webinar and also to share with us her experience at the US SEC and PCAOB on the various topics that we'll be discussing today. Carol.
Thank you, Willkie. First, I would like to give an overview of the audit committee member roles and responsibilities, and then I will discuss some new considerations for audit committees based on recent events. So next slide, please. This slide lists audit committee key roles and responsibilities based on the UK FRC corporate governance code. And some of the more important ones in today's discussion that we'll be going into include monitoring the integrity of the financial statements, including the significant financial reporting judgments, which is so critical in today's environment, as well as reviewing the effectiveness of the external audit process and auditor independence, and reviewing companies' internal controls, which is also very important in times like these where there's so much financial stress and an added potential for fraud. It's also critical in this time of COVID-19 and financial stress that directors really challenge management and the external auditors in the areas of financial reporting and internal controls. So next slide, please. The SEC in the United States also sees that the audit committee has a very vital role in financial reporting and internal controls over financial reporting, as well as the quality of the external audit. This slide highlights key areas in which the audit committee plays a role that were highlighted by the SEC in its December 2019 statement. The SEC emphasized that the audit committee should be exceptionally active during this crisis and also be very proactive. Plaintiffs' attorneys are already investigating COVID-19 disclosures and already filing securities class actions. Following the 2008 crisis, US regulators were under tremendous pressure to prosecute individuals, and the SEC started putting more emphasis on audit committee members and their role as gatekeepers. And in the past, the SEC has settled with a number of audit committee members and directors over financial reporting issues. The SEC's Office of Chief Accountant also issued a statement last month about the key role of the audit committee in the financial reporting and the external independent audit process. So I won't be commenting on all of these areas on this slide today, but I wanted to point out that the tone at the top is so important. Audit committees should set an expectation that they will be asking probing questions about issues and internal controls, and will be challenging auditors and management and understanding the resolution of issues. Regarding independence, the SEC encouraged the audit committees to consider the sufficiency of the auditor's own monitoring processes over independence. And this of course, is part of the audit firm's quality control systems. So this is an important area for audit committees to be thinking about. Another area I wanted to highlight are non-GAAP measures. Both the SEC and FRC have both commented recently on those. Of course, the traditional non-GAAP measure is EBITDA, and now we have EBITDA-C, or coronavirus. So, this is so important to investors and has an impact on loan covenants. And the SEC encouraged audit committees to actively engage in review on non-GAAP measures and ask about reasons for changes to non-GAAP measures and whether those changes and disclosures are compliant with SEC regulations. In May, the FRC said that alternative performance measures which attempt to provide a measure of pro forma results which exclude the estimated effect of the COVID-19 crisis are likely to be highly subjective and therefore potentially unreliable. Next slide, please. We've shown here some of the recent accounting scandals that have been in the news lately. And of course, this has put the audit profession under spotlight with questions about audit quality, and also has raised additional questions about the responsibilities of directors. And of course, this, accounting scandal could have a very significant impact on directors and audit committees, both a personal impact with time spent, personal exposure, and the possibility of testimonies or interviews by regulators. Next slide, please. Here we've shown some of the recent studies and guidelines that have been issued or commissioned by the UK government. And most of them do get into the importance of the quality of the external audit and the importance of the audit committee members' roles. While we won't be going into each of these in detail today, some key messages in these reports are that audit committees should challenge external auditors to demonstrate to the audit committee that a high quality audit was performed. So they're suggesting almost that there should be some evidence provided. Audit committees should challenge where they need further explanations or where they identify apparent inconsistencies with their own knowledge. And audit committees should take actions to review audit quality and independence. So this is where I was mentioning before, proactive actions. And we'll be talking later about some questions that audit committee members can ask in that regard. To note here, the CMA in its 2019 study said that regulators should hold audit committees more vigorously to account, and that regulators should issue public reprimands to companies whose audit committees fall short of auditor scrutiny. The FRC in May said that it is continuing to work with the Parliamentary Committee on Business, Energy, and Industrial Strategy to implement recommendations for the new Audit Reporting and Governance Authority, also known as ARGA, into which the FRC will be merged. But the new recommendations would include new enforcement powers to hold non-accountant directors responsible for financial reporting. And the Kingman Review also recommended that ARGA be given more powers to hold non-accountant directors to account. So all of these events show an increased focus on the role of the audit committee, and they may trend to holding audit committees accountable in regulatory or private litigation. With that background, I'd like to turn it over to Peter and Simon now to discuss legal ramifications and exposure for directors when approving financial statements.
Thank you very much, Carol. And as Carol said, when I look at those reviews, what emerges is that the role of the audit committee and therefore the individual responsibilities of board members on the committees will be greatly extended. And so the focus on the potential liability of directors will be heightened. And it's heightened in an environment where already the market is seeing more of a focus on the discharge of directors' duties generally, and specifically with regards to accounting controls failures and financial statements. So over the next few minutes, I'm going to run through some of the areas of law I consider most relevant. And importantly, these are not hidden areas or lesser used provisions of statute. They present real risks to directors and are frequently used in litigation. Both Peter and I act on both claimant and defendant side in those litigations. And they've given rise to a number of practical considerations which we will explore. So on the next slide, to state the obvious, audit committee members as directors have fiduciary duties to the company and to its shareholders. And of course, when the zone of insolvency comes lurking, as it continues to do for so many businesses at present, creditors. So as you will all be aware, directors' duties in the UK are codified in the Companies Act. So you'll be familiar with those duties, acting within the company's constitution, avoiding conflicts, promoting the success of the company, etc. But the audit committee has a particular role, acting independently from the executive to ensure that the interests of shareholders are properly protected in relation to financial reporting and internal controls. And so having an appropriate balance of skills and experience, and the members being comfortable with their fellow members' skills within the audit committee, is an issue that will often come under scrutiny. And typically, it will be this duty here on the slide, the duty to exercise reasonable skill, care and diligence, and the duty to exercise independent judgment, which I will come on to, that come into the sharpest focus, and ones which, along with wrongful trading, are the most heavily litigated of late. And so just turning to those duties for a moment, you'll see on the slide there, the objective, on the previous slide, sorry, the objective and subjective tests for the 174 duty. If we just go back one slide. The presence of that objective test means that it's not open to a director to claim that their lack of skill and experience prevents them performing to at least the standards expected of a reasonably diligent person. And the objective test also expects that where a director occupies a role requiring a more defined skill set or experience, such as on the audit committee, there will be a greater expectation on them. And more generally, the court's current position in the UK, I've set out on the slide. The standards required of a director to discharge the duties are higher, perhaps, than at any time in the past. So where decisions, especially in a remote or distressed market, may be happening at a much greater speed or with challenges in communication, more than anyone would prefer, the importance of frequent updates, the utility of specific and detailed questions from directors, and importantly, creating time for the audit committee to be able to consider things ought not to be underestimated. Now, second, and turning to the next slide, the other duty, the independent judgment duty. Directors should not, in exercising their duties, allow their powers to be subordinate to the intentions of others, so fettering their discretion. And you can see on the slide there a nice quote. It is a breach of duty for a director to allow himself to be dominated, bamboozled, or manipulated by a dominant fellow director, where such involves a total abrogation of this responsibility. And so the tone from the top, that's a collective tone. And the history books show that in a large number of financial collapses or company scandal, there has been that one or two domineering influence and a lack of challenge to that influence. And oftentimes there's been a marked lack of any discussion at all. But independence does not mean isolation. Delegation and division of responsibility is expected, provided there is adequate supervision and oversight, and a clear designation, but not abdication of responsibility. And indeed, seeking independent advice may well go a long way to shielding a director from liability, provided that first, they have acted honestly and reasonably on the advice, and second, the manner in which the advice was sought stands up to scrutiny. So on that, I want to continue with the words of Justice Norris on the Salmon case there on the slide. He continued to say, "A director who says, 'Here's the keys to the warehouse, see what you can find, but in general I want to see how little I can get away with,' stands on a very different footing from one who says, 'These are matters which particularly concern me, and here is everything I know about the issues. What must I do to make sure I have fully complied with my duty?'" So before moving on, just a word on the different approaches of the US and the UK courts. In the UK, unlike typically in the US, judges are quite prepared to examine the business efficacy of business judgments exercised by company directors. The focus of the English courts is far more on the process by which the business judgment was reached, as well as the judgment itself. So it's going to examine the overall architecture of directors' decision-making, concerning itself with the content, the context and the process of decisions, including the workings of directors and how decisions are made. So it's going to ask whether the directors have taken appropriate steps to inform themselves of the relevant facts. Have they sought appropriate expert advice? Were they entitled to rely on that advice? And did they act responsibly and honestly? But sometimes it goes wrong. And so set out on the next slide, these are the consequences. So in short, expensive litigation, more often than not brought by shareholders in the name of the company, personal exposure, potential regulatory sanction, and possibly disqualification. But the Companies Act doesn't just stop at directors' duties. As we'll see on the next slide, it mandates criminal offences in respect of accounts and dealing with your auditors. A director can go to prison or pay an unlimited fine if they, for example, approve accounts without satisfying themselves that they give a fair and true value of the company, or provide false information to or mislead an auditor. So in times of uncertainty and the prevalence of adverse trends, key accounting and financial judgments are likely to be needed. And so again, the prospect of this offence gives rise to considerations of testing, asking the right questions, and ensuring adequate procedures and oversight is in place. So with that, I'm going to move on to misleading statements and impressions. That's not in the Companies Act, but in the Financial Services Act and the Financial Services and Markets Act. So on the next slide, I set out the two criminal offences under the Financial Services Act that I consider of most relevance here today. So in short, if you make a statement which you know to be false or misleading in a material respect, or are reckless as to whether it is or not, or dishonestly conceal material facts, then you will commit a criminal offence if it is proven you intended to induce or were reckless to inducing another person to enter into or avoid entering into a relevant agreement or to exercising their relevant rights. And I've set out there on the slide the near equivalent criminal offence for misleading impressions. So the diligence record, i.e. the steps taken to formulating the statement, is likely to be a key factor in defending any claim. Likewise, care with which forward-looking and outlook statements and holding statements, so where no definitive information is known but a holding statement is required, need to be approached with caution, with litigation in mind, and cannot be underestimated. And the SEC in particular has recently provided guidance in this regard. And Peter and I are frequently asked to look at the disclaimer and the cautionary language to attempt to mitigate those risks. And so finally, I'm going to look at untrue or misleading statements in listing particulars, prospectuses, and published material under FSMA, the Financial Services and Markets Act. So to put it in short terms, if someone suffers a loss as a result of any true or untrue or misleading statement, whether the director knew or was reckless as to the truth, then the director or issuer will be liable to pay compensation. Now, these two sections, sections 90 and 90A on the next slide, are rarely out of the company litigation headlines. You will all likely have heard of the RBS rights issue. We've heard already about the autonomy litigation, and the large UK supermarket chain Tesco has its own shareholder litigation, and they all focus on this liability. So Autonomy was the $5 billion trial between Hewlett-Packard and Autonomy against directors of Autonomy, with allegations that the defendants published information which, by virtue of certain improper transactions and accounting practices, included statements which they either knew to be untrue or misleading, or indeed just were reckless as to whether they were untrue or misleading. And likewise, after this summer break for the court, the shareholder litigation centering again on the Section 90A offence and alleged losses to the tune of £450 million for Tesco's after a profit overstatement of £250 million will begin. So we're going to watch that with interest. So these are real risks, and risks that are frequently litigated. And so with that in mind, I'd like to hand over to Peter, who's going to look at what audit committees could be considering to reduce that exposure and attempt to fulfil their duties. Peter, you need to unmute.
Thank you, Simon. Sorry about that. So Simon's helpfully set out what the legal duties are, and I wanted to take this to a sort of practical level now. As I mentioned at the outset, I've been in this role for about 30 years, and through various crises, whether it's BC Sign, Bearings in the early 1990s, or Transtech and SSL around the time of the noughties, or RBS and other cases in the last financial crisis, bringing ourselves right up to date with 1MDB and Tesco, which Simon has referred to. There are a number of common issues that arise, and I hope to address those today. Whilst we talk about the legal duties, I mean, ultimately, from my perspective, the fundamental question or duty is, these are your accounts, they're your financial statements. And of course, some of the provisions that Simon has referred to talk about exposure for recklessness, which is effectively another way of saying that you've behaved unreasonably in a way that no reasonable person would have behaved. But they are your accounts, and therefore it is the director's duties and the audit committee's duty to ask questions and to make sure that they understand the key accounting judgments that underpin those accounts, whether they be revenue recognition, impairment, going concern, or provisioning, topics that Matthew is going to turn to later on. And to give an example, I always think it's interesting when it comes to the question of litigation provisioning. Frequently, Simon and I are called upon to give a view as to whether or not the provision or a provision is required, and if a provision is required, whether or not it is appropriate. And we always sometimes wonder when we are providing those opinions, whether the directors have already reached a view as to what the appropriate provision is, and then we are being asked to confirm whether or not that view is reasonable, or whether actually the board is saying, well, look, you're the experts, you're the litigators, you know the litigation, actually you need to come up with what the provision is, and then we will adopt whatever recommendation you give to us. And of course, actually the right way around is it's the director's responsibility to come up with that provision and then for us to confirm whether or not it is reasonable. And it just is a good example of how the responsibility is split between the directors and external advisors in our case, or auditors from the perspective of producing an audit opinion on the accounts. That's not to say that reliance is never okay, but what it means is that reliance on the opinions of third parties goes with a responsibility to ensure that those third parties have properly discharged their roles. So I like to think about reliance, not abdication of responsibility. And as Carol said earlier, the other part of the director's duty is to challenge the auditors as to the scope of their audit. And frequently when I come in and look at issues after the event, sometimes one gets the impression that the company is looking to see how good a score they're getting from the auditors, i.e. how well do they do in preparing the accounts, as opposed to actually how good a score should we give the auditors for their audit on the accounts. And I think what one can see now is that there is a greater emphasis on directors and audit committees challenging the auditors in their audit work, as opposed to living in fear of what the auditors might say at the end of the audit process. So with those introductory remarks, I've set out on this slide and then on the next one a few practical points which I'll just talk about. So the first question is, has the board assessed whether the audit committee has the balance of skills and experience necessary to fulfill its remit? Frequently, the audit committee will have upon it members who are much more financially expert, maybe former accountants, etc. And therefore, clearly, one will look to see whether that audit committee has the necessary balance of skills to discharge its role. And if the board has assessed that, then where is that documented, if at all? Because this all forms part of the appropriate reliance that the board can place on the work that the audit committee undertakes. Of course, one of the other aspects, looking at this from the other way, is do the audit committee members themselves feel that they have the requisite skills and expertise in order to discharge the responsibilities that have been placed upon them? It's always an interesting question. As times change, whether you feel that your skills are still up to it in terms of discharge of that role, particularly given the increased responsibilities that Karen has already talked about. And secondly, what about audit committee meetings? Do the meeting agendas allow sufficient time for full discussion of the audit committee's work? Again, frequently when we go in and we talk to audit committee members, they are busy people. And sometimes, particularly in times of crisis, which of course is when these decisions are frequently then subject to challenge months or years down the line, a common complaint is, well, there wasn't sufficient time for us to discuss all of the points we wanted to in detail. But secondly, is there sufficient time to have a discussion just as the audit committee? Management will be there and the external auditors will be there. But what about the audit committee members themselves getting together and having a discussion before inviting those parties into the meeting? And it may well be that that actually needs to be a discussion that happens the day before. And all of this therefore needs to be built into the timetable. Frequently, one actually sees that there are deficiencies in some of the papers that are produced to audit committee members, and that in the good times, there is sufficient opportunity to then ask for supplemental papers to be produced so that the audit committee has all the requisite information before it. So that clearly needs to be built into it, in the same way that the agendas need to be sufficiently detailed, so that when Simon and I and others come along months and years down the line, there is at least a starting point to working out what was discussed at those particular meetings. And I'm going to come back to that because documentation, I think, in my experience over 30 years, is a key issue. Next, are documents for the committee circulated sufficiently in advance to enable them to be properly considered? It may come as a surprise, but in some of the regulatory investigations in which we've been involved, the regulators have been particularly interested in actually working out, well, at what time of night were the audit committee papers or board papers released to the members? What else was in their diaries? Had they set aside sufficient reading time? And did they then use that reading time to read those papers? And it may seem a little bit pedantic and caught up in the detail to go through that, but actually that is what can happen after the event, and whether or not there was a proper process and a proper opportunity for consideration. So the first thing is about time for the audit committee. Secondly, time to consider the papers. Next thing, of course, is there then a proper record of the consideration that is then undertaken? And of course, what I see frequently is that minutes are prepared, and less so in the context of an audit committee, but frequently in the case of a board meeting, where often you could write those meeting minutes before the meeting actually takes place. And almost all that happens is that the blanks are filled in. And of course, that then gives rise to a question as to whether or not each of the items in the minutes were properly considered and properly discussed. But of course, what we also find in this modern day and age is that there are still handwritten notes around or other electronic records of those meetings. And what is always of interest to me is that great attention is paid to the formal minutes and they are formally approved. But in a large number of cases in which I've been involved, actually the real meat of what was discussed and the really helpful evidence is actually in the handwritten notes of those meetings. And it always worries me, therefore, it makes me wonder why people say, well, handwritten notes should be destroyed after the event, because actually in a number of cases, it's those that have helped the directors out to show that there was a proper consideration, that there was a proper debate, there was a discussion, and proper judgment calls were reached at the end of the day. So actually, you won't come as any surprise to find or hear me say that I am in favour of fuller meeting minutes and fuller or handwritten notes being kept and potentially reviewed for accuracy. What of course does, in this modern day and age where we've all been used to remote working, of course papers are now frequently distributed electronically, and I can mark them up on my computer and highlight the relevant bits and pieces. But of course, if at the end of the day, all of that goes into the electronic waste bin and is lost for all time, in 4 or 5 years' time when a judgment call comes to be considered or criticised, it will be very difficult to remember exactly what the issues were that were so important those many, many years ago. So even for electronic review, I would urge for those records to be kept rather than disposed of. Now, point number 5, are you satisfied that the company has adequate internal controls over risk and an adequate internal audit function? And of course, one would hope that you've built up that knowledge over time and that assessment over time. But of course, at present, with COVID and remote working and changes to systems and controls, actually, has there been a reassessment done such that you can place reliance upon those controls in the current financial crisis? And of course, one of the other aspects which goes along with this is whether or not there has been a fraud risk assessment. A number of companies, I think, have benefited from having carried one out. Of course, others probably haven't carried one out, and we can read about those, no doubt, in the news in the months and years to come. It's a valuable tool for understanding where the key risks are as far as the organisation is concerned and its exposure to fraud. And then lastly on this slide, are there clear procedures and triggers in place to elevate risks or concerns to the board quickly from the audit committee? And if so, are they effective, and is the audit committee happy that they can exercise that right of not having to wait for a formal board meeting? What is very interesting is when one compares the number of board meetings in the last financial crisis to the normal level of board meetings. Of course, a much greater number were required in order to deal with risks that were arising, and that shows, in my view, good corporate governance. Then the last few points, which are on the next slide, are the committee's own processes for considering financial statements and any other relevant documents adequate? If the committee doesn't follow its own process, then it opens a chink, and I'm afraid to say from that chink, frequently the door is then barged open by litigators months and years after the event. The next thing is back to my chestnut, which is, what is the procedure where members of the audit committee are not in consensus? we all remember that accounts show a true and fair view, not the true and fair view, and therefore there is an opportunity for different opinions to be reasonably held. Again, my advice would be to ensure that that is recorded and documented, and whatever the majority view is also documented and recorded, and the rationale for why that view is gone. Unfortunately, hindsight shows me that at times it is the minority whose views can be subsequently proven to be right, but that doesn't mean that the majority view was wrong or that those directors failed to discharge their duties. Then the next couple of points are all about the increased stresses, of course, which business are under at the moment, as Simon and Karen have already mentioned. And of course, when one looks back over history in terms of a number of big frauds that have occurred or financial errors that have occurred, frequently one can point to cultural issues within the organisation and within the management structure. And sometimes that culture flows over into the board with a domineering CEO or CFO. And of course, to stand against that needs an effective chairmanship of the board and an effective audit committee to ensure that issues are properly considered, elevated and discussed, and that all of the directors have an opportunity to be part of that discussion. It always concerns me when I see a board meeting which starts with a view from the CFO, followed by the CEO, followed by the expert accountant board members, such that the other non-executive directors who may be less au fait with accounting standards and the like are really left with no opportunity to really challenge what's gone on, because everything starts to read like a fait accompli. And then my last point here is, is there a procedure whereby the committee and the board can take advice? And if so, do board members understand how easy it is or should be to trigger that? And here I'm talking about whether or not the board itself needs its own independent advice, as opposed to calling on the general counsel to obtain further input, either from the company's own legal team or from external advisors. Something which I think boards should think about before that difficult occasion when it may well be required. So that's all I needed to say at this point in time, apart from, very importantly, on the next slide, the CLE code, which for today's purposes is WFG 1565. So if you please make sure you enter that on the attendance sheet, and I'll issue a reminder at the end of the webinar today. But with that, if I can hand over to Carol, please.
Thank you, Simon and Peter, for that very insightful discussion. Next slide, please. What I'd like to do first, before I dive into audit quality, is remind the audience to submit any questions you may have for the panel by using the Q&A feature. So I'd like to discuss some key areas for audit committee members to consider when interacting with the external auditors. Next slide, please. Here we've listed some key questions that audit committee members can ask and key actions that they can take when dealing with their auditors. So it's primarily, as we've said before in today's webinar, challenge the auditor and ask probing questions. This goes early on in the audit, and even in terms of the audit plan. Obviously, the audit planning will be changing a lot. It's going to be starting soon for the 2020 audits, and the plan may be changing a lot from last year's plan or last year's audit due to the current COVID situation and all the remote work that's going on. So the audit committee should be able to be willing to probe and challenge the audit plan. Specifically, questions can be asked about risk assessments of material misstatement at the account level, because that's how auditors do their risk assessment, and also audit procedures for judgmental areas such as going concern, impairments, and also procedures to address changes in internal controls. So carefully questioning auditors about their scope and their approach and whether they rely on controls in certain areas can reveal much about the control environment as well. The audit committee should attempt to get full and robust answers, and also should understand how auditors challenged management in complex and judgmental areas. One thing that could be done here is the audit committee could ask to speak to other partners at the firm who were consulted on difficult judgments. In terms of the auditors' internal quality control procedures, the audit committee should be asking questions at the firm level about the firm's internal quality controls. The quality control system of the firm provides a quality foundation for all of the audits that are performed. And these controls include training, internal inspection programs, practices for partner management, how partners are evaluated, what the firm does to respond to deficiencies in audit quality that have already been identified, perhaps through an inspection. What processes does the firm have to analyze root causes of audit failures? Are there independence policies and procedures? What is the tone at the top? And how do firms monitor the use of technology in their audits? Especially that's important now because of this remote, conducting audits remotely and the use of technology to do that. When I was at the PCAOB and the SEC, I saw many instances of where audit firms' quality control systems were not robust enough to ensure a consistent audit quality. And this usually stemmed from a lack of appropriate tone at the top. And it can lead to a lack of independence on behalf of the auditor, management accommodation, such as the auditor not challenging management about booking material unrecorded adjustments identified in the audit, and even to many instances of improper audit work paper alterations in advance of regulator inspections. Deficiencies in the firm's system of quality control were alleged in many of the PCAOB's 2019 enforcement actions. And today the FRC released its latest audit inspection results of the 7 largest firms in the UK. They assessed the firm's quality control systems and looked at 88 audits and concluded that 33% of the audits still require an improvement and are unacceptable. They specifically commented on the firm's QC system, saying that the tone at the top needs to support a culture of challenge to go back and to back auditors who are making tough decisions. And they added that auditors were failing to challenge management. The audit committee should inquire about this, and also the audit committee can ask its auditor if the firm has received inquiries from regulators or is undergoing FRC or PCAOB investigations, and what areas are being investigated. With respect to auditor independence, this is key. Audit committees should continue to probe on the audit firm's independence and culture and be able to explain how it got comfortable with this area, because the auditor's mindset and culture is not a tangible area and it could be difficult to assess. Audit quality indicators. One of the studies issued in May 2020 by the FRC looked at the most useful audit quality indicators that are also known as AQIs of both poor and good audit quality in the UK. The study shared that if used properly, AQIs are a vital tool to help audit firms detect audits that are at risk and for audit committees to hold audit firms accountable. AQIs can be quantitative or qualitative. Examples are number of engagement quality review partner hours spent on an audit, partner and senior staff hours as a % of the total audit. An example of where an AQI could have proved useful was the audit of BHS, where the FRC's investigation in 2018 revealed that the engagement partner on the audit only spent 2 hours on the completion stage of the audit. The FRC spoke to over 100 audit committee chairs, and only 10% were aware that the audit firms in the UK publicly report AQIs. So this is an area that could help immensely with audit committees in looking at their audit quality of the firms. In the US, the PCAOB and its outreach to audit committees discussed AQIs. This outreach was performed in 2019, and audit committees had a varying level of familiarity with the term. So it appears that audit committees can benefit by digging into this area to understand how their auditors measure audit quality and to select relevant AQIs to discuss with their auditors. With respect to inspection reports, audit committees should understand the findings and what remedial actions firms are taking. And in terms of the quality control section in the US, this section of the report of the PCAOB is not public, but the firm is not prevented from sharing that information with the audit committee members and can share as well what they're doing to remedy and remediate those findings. Regarding documentation and evidence, I agree with Peter's previous points about documentation. I think it's very important in times like these for audit committees to evidence their reviews and assessments and to demonstrate that they did challenge auditors. And this will help defend themselves in the event the audit committee is challenged. I think when I was at the SEC and I was taking testimony of company officers and directors, I saw how having documentation to back up a witness's testimony can easily make a difference in weakening the government's case. Absence of documentation can raise questions, and documentation can be helpful to indicate why a board did not act on something and support that decision to not act. So without further ado, Toby, do you have any other comments on this area?
Thanks, Carol. I mean, I agree completely with what you said. And with Peter, we worked on a case that settled about 10 years ago, a sort of securities class action to do with financial statements sort of issues. And what was particularly interesting in that case was that there was one, possibly two audit committee members that had very robust attitudes and opinions about how and to what extent and in what detail contingent liability should be sort of reflected in the company's accounts. And I think in the end, that was extremely positive because it showed a functioning board and a proper governance structure. My sense is that these kinds of very, judgmental decisions and critical decisions are only going to be exacerbated in the COVID crisis in terms of post-balance sheet events, going concern, non-GAAP measures, many of the things that I think we have and will talk about. So I agree completely. Contemporaneous evidence that demonstrates a robust and sort of functioning challenge within the audit committee is really, really critical.
Okay, thank you, Toby. Now I will turn it over to my colleague, Matt, to discuss the risks and difficulties for audits and financial reporting resulting from COVID-19. And we anticipate that these will continue for the 2020 audits later this year.
Thank you, Carol. If you just, thank you, perfect. In this part of the webinar, I really want to talk about the effects of the pandemic on auditing so that audit committees can know the areas to check and challenge on their auditors. I think, having been an auditor many years ago, but thinking through 2020, it seems to be it's going to be one of those big tests for auditors like never before. So we've got a perfect storm really for companies and their auditors. We have everybody working at home, or most people working at home, and throughout the period since the end of March, really, processes and controls have been chopping and changing throughout the time as people do various amounts of working from home and working in the office. But financial statements still need to be produced and audits still need to happen. So if we turn to the next slide, I just wanted to highlight sort of three really big areas, and of course there are plenty more, but the three really big areas that I would like to highlight. Remote auditing is here to stay, I think. We're looking at very few people in the office generally, and the questions to ask the audit team is really how will they approach that, and what will that mean for the way that they do the audits? How are they going to do their walkthroughs? How are they going to inspect documents and make sure that they're legitimate? And how are they going to get a real sense of whether someone is really telling them how a process has been working properly? And more importantly, I think there will be robust discussions about audit fees this year as companies in straitened circumstances try and push them down, and auditors seek to recoup the costs of extra time they have to spend for the audit. The second area is the control environment, and as I mentioned, it's been up in the air. People will be different people will be doing different parts of controls. Controls will be reconfigured regularly over this period. And what does that mean for the audit team? How are they going to get assurance the controls have been working throughout the entire year, and how are they going to say, you know, this for this period, one set of controls are working, then they change this next set, and so on. And again, the audit committee should make sure they understand how the auditor will approach this and how they will deal with this. And finally, the risk landscape is really changed, as we've been talking about. And how do those risks affect the integrity of the financial statements? And again, the key challenge from the audit committee will be, how will the audit procedures address these very specific risks? If we move to the next slide, I want to talk about one specific risk, which we've mentioned already, which is fraud. And I'll turn to my old friend, which is the fraud triangle, which has, you know, which is valuable at all times, really, in terms of understanding whether there is a heightened risk of fraud within the organisation. And I think this applies to almost every single organisation at the moment in terms of the pressure. There'll be massive pressure on people through share prices going down, and cash flows being uncertain, and the need to really show that despite the problems we've had, we're going to turn the company around, and we're going to drive it forward, and we're going to succeed. But at the same time as that pressure is there, the opportunity for breaches of sort of the rules are opened up, because the controls, you know, as I said, are being up in the air, and they're moving around, and they keep changing, and so the opportunity is increased. And then on the other side, there is the rationalization. You know, we have management and we have staff saying, well, we are saving the company, we are saving the people's jobs, and all around these areas, these three sort of drivers, we up the risk of fraud. If we move to the next slide, then these steps here are really as old as the hills. They come from the ISO 240. But it's a good reminder to make sure that the audit committee is aware of what they should be looking for. They should be discussing fraud risk factors with their auditors, and they should be looking at making sure that the auditors and they understand which are the key controls that mitigate the risk of financial misstatement, material misstatements within the financial statements, and then making sure they understand how the auditor then gets to builds their assurance that there are no material discussing fraud risk with management and internal audit, looking at the auditor's assessment of the risk of management override, and then looking at the audit procedures themselves to look at to deal with that and make sure that's working properly. And finally, to look at the testing of manual journal entries. As I have found in much of the work that I've done, manual journal entries are the route to financial misstatements, not least revenue recognition, and other sort of softer areas which are susceptible to the adjustments through manual journals. And then, of course, looking at the training in fraud that auditors are doing now, and this is going to change in the very near future as the Bryden review has its effect in really focusing the mind of auditors on fraud and their skills in dealing with fraud. If we turn to the next slide. Then I just wanted to quickly turn on now to, I'm running out of time, but I wanted to quickly turn on to some of the key areas of judgment for directors as they move to approving the financial statements. We've got going concern, and I'm going to do that in a bit more detail in a second. Loan covenants. We've got uncertain future revenues. Cash flows are really up in the air, and how does that affect the adherence to loan covenants? What disclosures do shareholders need to see? You know, what information do they need in order to make their decisions, their investment decisions? How are the effects, the long-term effects of the pandemic, going to affect the value of your long-term assets and the impairments that you need to process for those? And finally, looking at what post-balance sheet events you should be reporting and how you should deal with them within the financial statements. If we move to the next slide, and thinking about going concern, the FRC published 2 weeks ago a review of what the audit firms were doing around going concern and the better practices that they observed. And I think in sum, the main messages that came through were that there should be a more formalized approach to risk-based and sort of risk-responsive audit programs around going concern. and that there should be more consultation, both consultation within, with fellow audit partners. And so you have the peer reviews of work papers and the peer reviews of the work paper that's in relation to going concern, and also the use of a non-audit specialist, the the M&A specialist, the valuation specialists that are within the accounting practices, and even the disputes people as well, in terms of looking at making sure that the going concern is something that is a valid assumption for the financial statements. As a final flourish, I will turn to the next slide and look at one example that I found when digging through the accounts of public companies from the last year, which were published. This was published at the back end of February, and if you just look in the highlights in the notes, the amount of words that were used to explain how the directors had come to the conclusion around going concern, and the fact that this company, Aston Martin Lagonda, was a going concern. Aston Martin had been spending huge amounts of money last year investing in new cars, and also building a factory. And it's really good to see in terms of the amount of information they were providing. They did have material uncertainty, and they were expecting, and they said that there was a reasonable expectation that through a rights issue and a placing of shares, that they would be able to raise enough money to maintain the company as it is. And then they concluded that on that basis, the financial statements could be prepared on a going concern basis. Now, digging further into those accounts, and it sort of brings us back to what the audit committee should be doing, and it gives a very good, clear description of what they were doing. There were 3 additional unscheduled meetings of the audit committee during 2019 to deal with the issues that they were facing. And then at each of the meetings, they had a private session with the external auditor and with the head of internal audit, really to make sure that they could independently challenge what was going on, what the the conclusions and the assessments that were going on within the company. And they discussed the areas in terms of disclosure and making sure that those were appropriate. And finally, they specifically, and they highlight that they specifically made sure that they discussed going concern and viability, and they satisfied themselves as to the assumptions and the conclusions that then led to the production of these financial statements on a going concern basis. So I think I just want to wrap up very, very quickly in terms of it's really important now that audit committees use their abilities to challenge and check what the management's doing and what the auditors are doing in terms of these really, really difficult areas that they're being faced with as the pandemic continues, and it will continue for the next few years. Anyway, I'll hand over now to Toby, just to wrap up in any Q&A.
Thanks, Matt. I'll actually wrap up on behalf of Toby. So we do have a number of questions that we have received from our audience, and I would like to use this opportunity to remind people that we do take questions from the guests to be addressed by our panel. So the first question I have here is, could you comment on the risk possibly arising from experienced US directors serving in the UK that are not aware of the differences in both the US and UK law? Peter, maybe I could start with you and let Matt have a break after his long section.
Actually, I think Simon's going to jump into that one. I think he's done some very interesting cross-border cases between the US and the UK, so he can give his own practical spin to this.
Thank you, and thanks, Phil, for the question. I feared the answer is probably as you were expecting, is that the UK court won't have much sympathy for an experienced or an inexperienced US director sitting as a UK board member. The real risk, it seems to me, and that has often comes to a head, and I mentioned it in very fleeting terms earlier, just revolves around the business judgment rule, and to a degree good faith. Neither principles really exist within UK corporate governance and UK law when it comes to directors' duties. And so if in the US, the business judgment rule kind of, I guess, gets you off the hook because it was a good faith decision, that doesn't fly in the UK courts. And it really comes back round to the process and the deliberation, yes, there's the objective and the subjective tests here, but in frequent times I've been in court with experienced US directors, but the expectation at a minimum is that they are well aware of their codified duties under the Companies Act and behave or conduct themselves appropriately. So I'm afraid that there is no leeway for an experienced US director in the UK.
Thank you, Simon. I'm conscious we're on the hour, but we've got quite a number of interesting questions. So please do stay with us if you would like to follow on with some of the questions. We're trying to address a couple more before we close out the session. So the next question I have here is, for international corporations, do you find many issues surrounding GDPR challenging access to audit information? Peter, Toby?
Yeah, let me have a go at that one. So I think it was an interesting question. When I paused and I was thinking, have clients struggled with this issue? And actually, I think the honest answer is no, I haven't come across these situations where clients have got entangled with this with the auditors. I mean, the auditors have pretty broad rights in terms of access rights to the company's documentation, and GDPR is not designed to get in the way of the external audit process. It sort of reminds me of some of the discussions that we have had going back over the years where, there may have been a piece of litigation or an internal investigation of some sort, and there's a lot of privileged documentation that has been created around that. And of course, the company doesn't want to disclose that privileged information to the auditors. In the UK, they can do so if they wish to without losing privilege in it, because our waiver rules are much more friendly in that sense. But from a US perspective, much greater issues arise if you disclose privileged information to an external audit firm, because the waiver rules in the US are much more limited. And we've always had this battle, even in the UK, that privilege is supposed to be sacrosanct. But at the end of the day, if there is privileged information there, and it is necessary for the auditors to discharge their role and they can't get access to it, they have the trump card, which is, of course, they qualify the audit opinion. And so at the end of the day, I haven't come across a situation where if it's, there might be a discussion about whether they need it, but if actually at the end of the day it is required, or normally we have found a way through, as opposed to having, the issuance of a qualified audit opinion, given the serious issues that gives rise to.
Thank you, Peter.
And I can add to that from the auditor's perspective. I mean, the auditors have to determine why they need the personal data, and they have to determine how they will process it and store it. And then when they're, I have seen when the PCAOB was trying to get information from, a foreign auditor, this came into, became an issue and really could hold up the production of documents to the regulator, because they had to be, looked at from the GDPR perspective.
I think that's right, Carol. I mean, we have the same issue in the UK, which is whilst the auditor can get hold of privileged information from the audit from the company, actually, if the regulators come in, and there's been a High Court battle recently whereby the FRC wanted to have access to the privileged papers of the company, which were relevant to the auditor's work, and of course the company said, well, no, this is our privilege. We don't want to hand this over to the FRC, and we shouldn't be obliged to do so. And so again, we have the similar sort of issues there. So there's a freer flow of information between external auditors and the company than there is sometimes between those who are having the difficult job of exercising oversight.
Thank you, Peter. Thank you, Carol. I do have another question here. How should directors for companies that do not have an audit committee think about their responsibilities with respect to the financial statements? Carol, perhaps we could start with you and then hand over to Peter and Simon.
Well, I would say that not having an audit committee doesn't change the responsibility for the company to still perform the duties that the audit committee would have to perform with respect to the financial statements. To make a very simple answer, that's my understanding. Peter or Simon, do you have any other thoughts?
No, I would echo those, Carol. Thanks for the question, Alison. I think really it comes back round to everything that we've been discussing today, whether you are a director on an audit committee or you are just the director looking at the responsibility, looking at the financial statements, and certainly in the UK, looking at all those offences and trips and hurdles that I was discussing earlier and Peter looked at too. They fall on a director as much as they do an audit committee member.
Yeah, I think you're absolutely right, Simon. What it means is it makes the job of the director without the audit committee more onerous in that sense. And whilst, of course, you might not therefore have the expertise that members of the audit committee have, so therefore to that extent you will be subject to a slightly different standard of expectation. Nevertheless, the sorts of issues that Carol and Matt and I have been talking about in terms of challenge to the auditors and understanding the key judgments, I'm afraid to say that falls on you. And it may well be that in that situation, you do need some external assistance if you really are concerned about whether or not you have everything at your fingertips. But of course, that again that's reliance, not abdication of responsibility, but bringing in experts to help you to get to the right view. But as directors, that is your job at the end of the day to reach a view on the accounts and a whole host of other issues.
Thank you, Peter. Thank you, Simon.
Just in case, I'm happy to continue this, and Wendy, I think we should, because we keep having questions pouring in. But for those who can't stay and who want to dial off, I would just simply say that obviously, in order to receive your CLE credit, you must make sure to complete and sign the attendance sheet link and enter the code. And once the attendee then clicks finish, the Willkie CLE team will receive that form, and we can then process it for CLE credits. I'm happy for the rest, though, of course, to stay on. I'm enjoying these questions. They're good questions as well. So I'm sure my panelists, they're all nodding furiously. So I see the numbers increasing in the Q&A box. So bringing you back to you.
Cool. Toby, would you like to comment and chip in on some of your thoughts on the questions we have discussed so far?
No, sure. I mean, I think the critical issue is, to cover off and address as fully and frankly the challenges that we're going to face. And I think they're pretty unprecedented. I think with the financial crisis or the dot-com crisis or post 9/11, it didn't have the same macro impact, and also the certainty was significantly higher. So I think these considerations are going to happen for a very long time, and we're going to be faced with a number of financial statements issues, some of them relating to COVID-specific manipulations of revenue or impairments or whatever it might be. But I think there's going to be an awful lot of stuff that comes out historically, where sort of bull markets and effectively free money have managed to sort of drive the share price irrespective of some of the economic fundamentals of the company. And I think that's what we're going to be looking at. And I think for audit committees not to really push back on some of the key assumptions, and I think we've talked in the past about certain sort of organizations kitchen sinking, they have bad news, let's chuck everything else in. I think a lot of that needs to be properly scrutinized. And as we all know, I mean, Peter, the work that you do I think you're still working on matters that relate back to the financial crisis. And the problem that we have is that the longer you look back, the more political and societal influences and perspectives impact historical practices. And that can be also highly risky, especially if you find yourself in a US court faced by a jury being asked really quite complicated questions about accounting, which increasingly people think is a science rather than sort of a series of assumptions based on highly considered judgment calls. So, and obviously the audit committee itself and the relationships with the auditors fundamentally need to change, in my view.
Yeah, Toby, it's interesting your point about societal changes, etc. My example, actually, I was going to give was judicial changes, which, of course, back to the issue I was talking about earlier about record keeping. Judges recently have commented, won't name them, but effectively that they pay little or no regard to live witness testimony in the sense of, in terms of its weight and how much weight should be given to it, the focus on the contemporaneous documents. And that whilst witness evidence is of assistance, at the end of the day, they really want to hear from the documents themselves. And I think it's a consequence of the litigation process that we have in the UK. So, but if that's the judicial process, I can tell you now that's certainly my experience and Simon's experience when you're sitting down with the Serious Fraud Office or the FCA and others. And so, no matter how well the witness has prepared and cast their mind back to remember what happened at the time, if the records aren't there to support them, they're going to get quite a sceptical viewpoint from the regulators. And as I say, if it ends up in court, as frequently these matters do, the judge is going to be much more interested in the contemporaneous records. And we've seen, people therefore poring over handwritten notes and the shorthand as to what that then actually means. And that's when the testimony comes in, of course, because it can then expand the shorthand. But without handwritten notes, without the shorthand, then we are, in a much more tricky situation.
And I think, Carol, it would be helpful for you to sort of think back to when you were at the SEC and the PCAOB, so, the American accounting regulator, and how you foresee or foresaw or viewed the absence of information, or at least the absence of documented information relating to these really critical issues, which
it as a regulator, former regulator, it really weakens your case if there is contemporaneous documentation that can support the witness's position. So it's of critical importance that documentation, if, for an audit committee or directors, that documentation exists and that it shows that their duties, they did perform their duties in a diligent manner. So I think it's critical.
Thank you. I think we'll take one more last question, and I'm conscious that it's getting a bit late. So, and we'll get to the wrap up after that. So, the question that we have received is: once a company's share price is trading for pence, and hence the equity value of the company is now relatively low for some time, and no equity lawsuits have been filed, have you seen lawsuits in the UK from US or UK bondholders or other parties that are not equity holders? Simon, maybe that's one for you to start.
Yeah, I'll kick that off, and the short answer is yes. And frequently, I'm the one either defending it or bringing it for the bondholders, because it's not always about kind of the compensation that you may get from the value of the company, but there are other reasons why a bondholder may decide to either bring folks to account, or indeed it's often a negotiating tactic or a pressure point to try to bring about a change within the company, which the bondholder will end up restructuring or whatever it is, its own bonds and its own debt. So, as I say, the short answer is yes. More from I've seen it more from the UK bondholders, as one would expect as a UK lawyer, than the US bondholders, though.
And similarly, I mean, again, it's either those claims being brought directly, or you talked about the company having a relatively low value. It's not uncommon, of course, for the company then to be tipped over into administration by bondholders, and at that point in time, I can tell you now, the administrators will listen very carefully to what the bondholders have to say, and if they're going to finance the litigation and the claims, then those claims will be brought. And I've acted for administrators in those circumstances. So whilst yes, I mean non sort of prospectus-based claims, etc., are more tricky for bondholders, there are ways and means for them to make sure that their voices are heard and they have the ability to you get claims brought against directors who have, or others for that matter, who may have failed to discharge their duties.
Thank you, Simon. Thank you, Peter. Unfortunately, I think that's all the time we have, and we've already overrun. Thank you for staying with us. For those of you who have submitted your questions to us and we haven't been able to address them, we will respond to your questions directly via email. We do hope that you found today's webinar useful. This is most definitely a watch the space subject as pressure mounts for companies, auditors, and the regulators to drive further improvement around financial reporting, to increase accountability, and to reduce the number of accounting scandals that we're seeing. If you would like to reach out to us directly for further questions, or even have a discussion with us, please do reach out to us. Our contact information is on our respective websites. And before we sign off, I would like to hand it over to Peter one last time to remind us regarding CLE credits.
Yes, so once again, so if you could then complete the attendance form, make sure you sign the attendance sheet and enter the code, and then click finish so that the Willkie CLE team can receive and process that form. I'll be very grateful. Otherwise, I want to thank my fellow panelists today. I've enjoyed this joined up webinar rather, between FRA and Willkie Farr, and I look forward to the next one. Thank you.
Thank you.